Stocks have fallen sharply this Monday morning as investors brace for US tariffs. European shares hit a two-month low after Asian markets also slid 2 days ahead of President Trump's so-called Liberation Day, when the US president has promised widespread tariffs will take effect. Well, Altaf Kassam is Europe head of investment strategy at State Street. Altaf, have investors been too slow in realising President Trump was actually serious about this, do you think?
Yes, good morning. Yeah, I think we went into this year thinking that tariffs would be used primarily as a negotiation tactic and that we should take Trump seriously, but not literally. But he seems to have literally followed through with the tariffs. And so the market has been running to catch up. There's been a bit of backwards and forwards, especially with Mexico and Canada. But it does feel like with Liberation Day approaching on Wednesday, the market is like I say, racing to catch up with the idea that he might actually follow through on a lot of what he's been saying.
Just how much economic impact should investors start to price in? Should they be anticipating a recession?
We think a recession is far-fetched. There's definitely going to be an impact on growth. There's definitely going to be an impact on inflation, and we've taken our growth numbers down and we've put our inflation numbers up. But compared to where the US economy was and where we would need to be to see a recession, we still think there's a long way to go. So we think recession is far away. Slowing growth and higher inflation are definitely on the cards, but there are some also contributing positive factors from what's happening in Europe and what's happening in China. So on the whole, overall, in the global economy, it's not as bad as some might be fearing.
You mentioned positive factors. How do you position for this then? Do you move away from America to make Europe great again trades, like perhaps European defence?
Yeah, I think a lot of those trades have already happened. So on the equity side, it feels like that trade was starting to happen even as late as the end of last year through the beginning of this year. And it's carried on clearly with the German fiscal debt brake being released. So I don't feel like there's a lot more room to run in the European equity market, and particularly defense trades. Where I do think there might still be a bit room in the short term is in the euro, but you might want to start fading that in the second half of the year because Europe still has structural problems, it still has weak growth, and those are going to come to the fore. But at the moment, I think the euro will still take that sugar rush from the fiscal debt brake being released in Germany.
What about European bonds? Markets are preparing for a lot more issuance from governments, aren't they? Both from Germany in particular and jointly from the EU to back that defence spending. Will they attract investors moving away from US exposure?
I think where they will attract investors because they will now have a higher yield, and that's a lot more attractive. So we've got used to this world where the US had the highest yield in the G10 and Europe was somewhere near the bottom, and it's been zero or even negative in the recent past. The fact that the yield in Europe has jumped is going to make those bonds more attractive. Now, at the same time, Germany has a lot of fiscal room. Investors are more comfortable about Germany issuing debt, less so with France, and we've seen in the recent past, definitely less so with the UK. So I think it's going to be a bit more selective. I think we might see investors move into investment grade credit as well and away from European government bonds. But there's definitely going to be a rebalance with some money coming out of treasuries, even though they still have the highest yield, and a bit more going into European government bonds and probably European credit as well.
That was Altaf Kassam of State Street. Don't forget, you can watch more videos on Reuters.com.